is Raman, your tutor from Alberta Real Estate School. Today we'll take a look at TDS ratio, or total debt service ratio. This is one of the ratios that you need to know for your mortgage exam. TDS ratio is something that the bank will look at when they are qualifying somebody for the mortgage. So let's dive in. Let's take a look at how to calculate the total debt service ratio. First of all, what is the total debt service ratio? The TDS ratio, or the total debt service ratio, is the percentage of the annual income that is required to cover all the debt obligations that the person may have, in addition to covering their mortgage payments as well as the housing costs. This ratio will basically show the lenders whether the person has ability to make their mortgage payments in addition to meeting their housing costs as well as other debt that they may be carrying. This ratio is one of the affordability calculations that the lenders will use in order to see if the person will qualify for a mortgage. So what does the TDS include? The total debt service ratio will include principal, interest, property taxes, heating costs, as well as half of the condo fees if it's a condominium property, and other debt that the person may have. The formula for TDS will be principal plus interest plus property taxes plus heating cost, half of the condo fees if applicable, plus any other debt payments that they have, divided by the gross monthly income. So basically it's the GDS formula plus any additional debt, and then we are taking that over the gross monthly income. Other debt. What does other debt mean? Other debt is everything that the person is responsible for other than the mortgage. So for example, if the person is making car payments, if the person has student loan payments they have to make, or credit card payments that they're making, all these things will be included in the total debt payments. Now, before we go to the calculations, there's two things to understand here. This is the types of debt. So there's secured debt and there is unsecured debt. Secured debt is the debt where the lender has a security for the loan or the debt that has been taken on by a person. For example, a mortgage. When a person has a mortgage, the house is the security for that mortgage. So if a person doesn't make their mortgage payments, the lender can then sell the house and recover the money they have lent. Car is another type of secured debt. So in this case, the lender is giving money for the car. If the person stops making car payments, the lender can repossess the car, sell it, and recover the money that they have lent. So this type of debt where the lender is able to sell something in order to recover the money is called a secured debt. Unsecured debt, on the other hand, is where the person does not have any kind of security. For example, credit card debt. So in this case, if the person stops making payments on their credit card, the lender doesn't have anything to sell in order to recover that money. So that's unsecured debt. And there's a bit of a difference in terms of how we go about accounting for secured versus unsecured debt in our calculations. So first of all, let's take a look at secured debt. For secured debt, the monthly payment will be 1% of the outstanding debt. So whatever their outstanding balance is on that loan, we are going to use a 1% of that outstanding balance to calculate our monthly payment. So for example, let's say there's $10,000 outstanding on a secured line of credit. The payment in this case would be $10,000 times 1%. So for example, let's say somebody has $10,000 outstanding on a secured line of credit, for example, HELOC, which is the home equity line of credit. So in this case, when we look at the payment would be 1% of the outstanding balance, which is $10,000. So in this case, $10,000 times 1% will give us $100. So that's what we are going to use for our payment. In terms of unsecured debt, now the calculation is slightly different. For unsecured debt, the monthly payment will be 3% of the outstanding balance. So in this case, if it's $10,000 outstanding on a credit card, for example, the payment will be $10,000 times 3%, which gives us $300. So the payment on the unsecured debt is 3 times as much as the payment on secured debt. And this can make quite a difference in terms of our TDS calculations. So we have to be careful with this one. The TDS limit for mortgages generally is around 42%. So this is the benchmark we are going to use. So if a person has the TDS ratio of more than 42%, they won't qualify for the mortgage, although some lenders will have flexibility, some leeway in this one. However, we'll use 42% as our benchmark. So if the TDS ratio is less than 42%, then the person will qualify for the mortgage. If it's more than 42%, then they won't qualify for the mortgage. Let's take a look at some practice questions here. Question number 1, Marissa and David Smith wish to purchase a house subject to financing. Their yearly gross income is $72,000. Their monthly mortgage payment is $1,400, which includes the principal and interest. The property taxes are $4,200 for the year. The estimated monthly heating costs for the property they're interested in buying are $120. In addition to this, they have borrowed $12,000 from their secured line of credit to cover their wedding expenses last year. Would Marissa and David qualify for the mortgage on the desired property? So let's take a look at the variables that we have in this particular situation. Their gross household income is $72,000 per year, and we need to convert that into a monthly number. So we'll take 72,000 divided by 12, which gives us $6,000 for the month in terms of income. Their mortgage payment, which includes principal and interest, is $1,400 for the month. The property taxes are $4,200 per year. So again, we need to convert that into a monthly amount. So we'll divide that by 12, which gives us $350 per month. The heating costs are $120 per month. And their line of credit, which is a secure line of credit, is $12,000, has an outstanding balance of $12,000. So in this case, we will take 1% of that, and that gives us $120 per month. So those are the variables that we are going to use. Now, again, the formula that we will use for calculating the TDS would be principal plus interest plus property taxes plus heating costs and half of the condominium fees. In this case, there are no condo fees, so we will ignore that, plus other debt. So in this case, we had a secured line of credit, so we need to take the payment for that, and we divide that by monthly income. Okay, let's take a look at our calculations here. Our monthly mortgage payment is $1,400 for the month. Our property taxes are $350. Heating cost here would be $120. And then we have only other debt that we have is $120 payment for the secured line of credit. So we would add that. And that gives us $1,990. So these are the total payments that they have to account for. Now we'll take this number and divide it by the monthly income, which is $6,000, and that gives us 33%. So we multiply that by 100 to get 33%. So 33.16 is the TDS ratio. So in this case, the TDS ratio is less than 42%. Ours is only 33%, so they will qualify for the mortgage. So let's go back to the screen and we'll take a look at it once again. So for our calculation, first step was to calculate monthly housing expenses. So we'll have $1,400 plus $350 plus $120, and we have $120 extra for the secured line of credit. The total here is $1,990. And second step is to get our TDS, and we will take our $1,990 and we divide it by 6,000, and that gives us 0.3317. We multiply that by 100 to get our TDS. In this case, the TDS is less than 42%, so they will qualify for the mortgage. Let's take a look at the second question here. Jonathan and Leah want to buy a condominium property in Calgary. They have applied for a mortgage on that property. Their joint annual income is $150,000. The purchase price of the property is $725,000 with a monthly payment of $3,000, which includes principal and interest. The property taxes for the property are $6,000 for the year. Other property expenses include monthly condo fees for $300 and monthly heating costs estimated at $250. They also have a car payment of $400 and credit card debt of $15,000. Would Jonathan and Leah qualify for the mortgage? So let's take a look. So first off, we'll take a look at the variables that we need. So here the total household income is $150,000 for the year. So we have to convert that into monthly amounts. We divide $150,000 by 12 to get $12,500 for the month. Their mortgage payment, which includes principal and interest, is $3,000 per month. Property taxes are $6,000 for the year. So again, we convert them into the month. So we divide it by 12. So it's $500 per month. Condo fees are $300 for the month. So in this case, when we do the calculation, we will use half of this, which will be $150. Next, the heating costs are $250 for the month. Car payment is $400 for the month. And our credit card payment, in this case, the outstanding balance is $15,000. So we take that and we multiply by 3%, and that gives us $450. So this will be the total payment on the credit card. So looking at our TDS formula once again, it's principal plus interest plus property taxes plus heating costs and half of condominium fees plus other debt. And we'll divide that by gross monthly income. Let's take a look at our calculations here. We have $3,000 for our mortgage payment and $500 for property taxes. Our heating costs are $250. And plus we have condo fees here of $300. So we will divide that by 2, which gives us $150. So we'll add that. Plus other debt. Now we have car payment of $400, plus we have credit card payment of $450. So this gives us $4,750, and we will divide that by 12,500, which is our monthly income that has been given. And that gives us 0.38. We multiply that by 100 to get 38%. So in this case, their TDS ratio is 38%, which is lower than the 42%. So that's why they will qualify for the mortgage. Let's go back to our screen again. So in terms of our calculations, first we take into account the monthly expenses, which would be $3,000 for our mortgage, $500 for property taxes, $250 for the heating costs, $150 for condo fees, which is half of $300, $400 for car payment, and $450 for credit card payment here, which gives us a total of $4,750. Let's take a look at our screen again. So for calculation, the first step was to calculate the monthly expenses. In this case, we have $3,000 for the mortgage, which is principal and interest, $500 for our property taxes, $250 for heating costs, and then we have $150, which is half of the condo fees. Plus we have $400 for our car payment and $450 for credit card payment. We add all these together and we get $4,750. Second step is to calculate the TDS ratio. So we will take the $4,750 and we will divide it by the total income for the month, which is $12,500. And that gives us 0.38 or 38%. So our TDS ratio in this case is 38%. It's less than 42%, and therefore they will qualify for the mortgage. If the TDS ratio was higher than 42%, then they would not qualify for the mortgage. So that's it for today. I hope you enjoyed this video. If you would like any extra help with preparing for your real estate exam or mortgage brokerage exams, we have a lot of resources available for you. We provide study guides, extra practice questions. We have video courses as well as live training sessions that you can attend. I invite you to visit www.albertarealestateschool.com, or you can give us a call at 587-936-7779. See you next time. Bye for now.